All right, guys, in today's video, we are going to be talking about how over the past 6 months, Americans have quietly, very quietly, without most people's knowledge, become significantly poorer relative to the rest of the world. That's pretty much only because the US dollar index, the DXY, has fallen nearly 11% in the first half of 2025. That also marks the steepest first half decline of the dollar since 1773, which is pretty alarming and should be something that we should be paying attention to. Unfortunately, there are some more signs that this may just be the beginning and that there might be a lot more to come, but that's exactly what we're going to break down in this video, so let's get right into it. All right, just a little US dollar index history lesson. When that dollar index weakens, it means that your dollar is losing value relative to the rest of the currencies in the world. So when the DXY loses strength, things like the euro, the Canadian dollar, Swiss franc, whatever currency it is, gains value relative to the dollar, meaning that the US dollar goes less far than it used to. Your $1 can buy you less of a good than it used to be able to buy. For over a decade now, though, Americans have been very accustomed to having their dollar just exponentially rising in purchasing power. Since like 2010, 2011, the dollar index has risen by like 40%, which has significantly increased the global wealth of Americans, like by far. And when you pair that with all of the asset price increases, like within the stock market and the housing market, that all Americans across the board have seen and experienced, you could say that we've had it pretty good, and we have. And just to put that in perspective, the dollar has appreciated 27% against the euro, 80% against the yen, and 67% against the Australian dollar. And what that does is it makes US goods and assets even more powerful and more attractive on the world stage, which just attracts more foreign investors, which just boosts price even more, benefits all of us Americans that are holding those assets. So effectively, it has made Americans richer relative to the rest of the world. But that era that I just described, that we've been living for most of our adult lives, might be coming to an end. And the shift is probably not by accident, just based off of what Donald Trump is doing. So what Trump is doing, if you're unaware, is that he is kind of living out his prophecy that he's described repeatedly, that the dollar is overvalued. And he's blaming that pretty much solely on the US trade deficit and the hollowing out of the manufacturing sector, and how we've shipped pretty much all jobs overseas, or all manufacturing jobs anyways, overseas, and outsourced those, which has led to a very overvalued dollar. Trump does not want an overvalued dollar. He said repeatedly that he wants a weak dollar. Now, he's not entirely wrong here. A strong dollar does discourage foreign nations from buying US made goods because it just means that they're more expensive. So that only widens the trade gap and the trade deficit. Countries do not want to buy from us because our currency is so strong. That means our goods are so much more expensive. They can get their product elsewhere for just cheaper. And that's pretty much exactly what we've seen recently. That's why the trade deficit is so large. And that's why you hear so many people talking about the trade deficit. Now, it's not the only cause, but that is definitely one of the major ones. And that's what Trump's focusing on. So that's where a lot of the policy is going to be geared towards. So now that he's back in office, he's made his goal very clear: weaken the US dollar and reverse those trends at all costs. From what we're seeing, he also may very well succeed. He's kind of on his way to succeed in the first place, like I described in the very first part of this video, that we've already seen the DXY fall by 10, 11%. So let's look at some of the key factors that are driving the dollar's value and break them down in an easy to understand way. The main key factor that we're going to focus on today is interest rates. Okay, if you're not aware of interest rates, the Federal Reserve sets a baseline interest rate, the overnight rate. They're pretty much all other things that are tied to loans that use a rate are more or less based off of. There's different tiers: mortgage rates, auto loans, credit card loans. All of those things have different spreads above the overnight rate that the Federal Reserve sets. So although the Federal Reserve isn't directly controlling mortgage rates or directly controlling auto loans or how expensive it is for you to get to have a credit card balance and have a credit card loan, the rate that they set matters. So as of today, the rate that the Federal Reserve has set is about 4.5%. So in comparison to other countries, the European Central Bank's rate is like 2.25 or 2.15. So we are 2.35% roughly above where they are, meaning that our borrowing is 2.35% more expensive. However, that spread above other countries' rates, like Europe, makes the US dollar more attractive to hold for foreign investors. We can trace this interest rate advantage that we've had all the way back to 2015, 2016. And since then, we've had US yields just consistently outpacing a lot of people's, including Europe's, for this example, which makes the dollar just more rewarding to hold for us and for global investors as a whole. However, we did see times before this that was not the case, okay? In the 2000s, we had an interest rate spread that was negative. It was oftentimes negative compared to other countries. So Europe rates were higher than those that we had in the US. That's kind of what Trump is going for. That's his goal right now, is to get our rates lower than other countries' rates. Now, you might be asking why he wants to do that. That can be a lot more nuanced of a question, but honestly, doesn't really matter. We don't really need to know why he's doing it right now. We just need to see that he is doing it and understand what that means for us as an investor in the market of cryptocurrency, of stocks, of the housing market, of our investing lives. We need to understand the effect that that is going to have on us. If the dollar continues to lose value, what is that going to do for my money and my investments? And how far can this fall go? So on that point, we're going to look at what the Bank for International Settlements real effective exchange rate, which adjusts the dollar for inflation, basically says about how overvalued the dollar is. In early 2025, that index was at about 112. That we've only seen that level like 2 times before in history, in 1985 and 1970. Now, since early 2025, we have seen a minor decline, but it's still hovering at pretty much the tippity top of its historical range, which means that there is a lot more room to fall for the dollar to revert back to its long-term averages, and its historical mean is what they call it, reverting to the mean. And right now, to revert to that long-term average, that mean number is around 90. So that means the dollar would have to fall about another 15% from its current levels that we're at now. So there's a good chance that we're going to see a continuation towards that mean until we reach that level. However, we can keep going past that. Because if sentiment turns more negative against the dollar and the dollar starts to decline even more aggressively, we could see it enter undervalued territory for the first time in decades. But that's happened in the past. It's just not something that we've lived through. We've never had, me, myself, if you're 20, 30, you really haven't experienced an economy where the dollar is below its historical averages and a historical mean. So if we know that the dollar is going to decrease in strength, does that mean you should just short the dollar? No, you should just be looking at your current investments and what that is going to do for your current investments and the prices. So that gets into monetary policy. We have Trump's big, beautiful bill that he likes to call it, which is pretty much going to accelerate the dollar's decline because we have a pretty large increase in deficit spending. So in total, that bill has a lot that's going on, but the end result is that it is expected to drive about $4.5 trillion in deficit spending over the next decade. A lot of people are talking about, oh, we have a giant deficit spending problem. We have huge amount of debt, huge amount of interest that we have to pay on that debt. We need to get our deficit in control. I think that this is actually part of the strategy here. I don't think this is a bug and that we've just let it get away from us, at least right this bill anyways. I think that's the goal of this bill, is to increase deficit spending to weaken the dollar, because that's going to do a lot of things for risk assets. And I'm going to get into that in just a minute here. So we know historically that when the federal deficit shrinks, the dollar surges. So when a government tightens its fiscal belt, global confidence in the currency usually rises, and that attracts global investors. But when we see deficits widen, like they are now with this $4.5 trillion in increased deficit spending that I just talked about, the exact opposite pretty much happens. Investors lose faith in the dollar because we're increasing our debt. They're like, oh, you're not credible enough to pay back this debt that you're increasing. Why are you taking on even more debt? So we're going to lose confidence in the dollar. Now, to tie all of this together, what does that mean for you? Here's the whole point of the video. What does that mean for you as an investor who holds risk assets? What you need to know is that a weak dollar provides tailwinds to risk assets, okay? It is going to boost asset prices. This means that US stocks and real estate and cryptocurrency and you name it could benefit for a period of time because of this increase in deficit spending and a decrease in the price of the dollar and a decrease in the dollar strength. So if this trend is going to play out, the riskier the asset, the more it's going to actually do better. So when you look at something like Bitcoin, we know that that is historically inversely correlated to the strength of the US dollar. So when the dollar strength is going up, we know that Bitcoin is probably going sideways or down. And when the dollar strength is going down, we know that Bitcoin is probably going up in price. So if we are going to continue to see this trend play out and see the dollar fall over the foreseeable future, 6 months, a year, however long it takes for this narrative to pass and for the next news cycle to pick up, we are going to see Bitcoin and crypto go through the roof. We're going to use historical precedent and we're going to go forward in the future. And until we're proved wrong, past results don't guarantee future performance, but they can certainly give us a hint at what is next to come. Not that much has changed. We just know that this relationship is probably going to continue. So do with that what you will, guys. Bitcoin is not the only thing that's going to increase because of the decline in the strength of the US dollar. Like I said, there's going to be a lot of other assets that benefit from this. Pretty much all assets will. But when you look at things that are correlated or inversely correlated with the US dollar, that's a little focal point to hone in on. So you have gold and Bitcoin. I just focused on Bitcoin there because that's a major topic of conversation recently. So I urge you to go forward with this information. Go forward and do your own research on how to capitalize off of a weakening US dollar. There are plenty of different strategies out there for you guys to take advantage of, and I'll leave it at that. If you guys like this type of informative content, make sure to leave a like, hit that subscribe button, and let me know what you guys think in the comments. I wish you guys a great day, and I hope to see you in the next video. Peace.